All right, so welcome you all to IFRS's day 1. This is the day 2. Yes, yesterday was the day 1. We are on the day 2 now. Today we are going to look out for IAS 2 that talks about inventory into detail. You must understand how we could account for inventory. That is what we are going to look out for today. Yes, the captain for today's drive is the target leading, and then co-team members, all of them are in their right position. So join us. If you have any question, please don't forget to put in the comment section. All the team members are around, they will pick it up and then they will answer you accordingly. All right, so this is IFRS section. So if we should go straight to the game. Straight to the game. IFRS provide specific requirements. Specific what? Requirements. And this is what you must know, so that in preparing financial statements, you will get these specific requirements. So things you must know under each IFRS is very important. So things you must know. Or issues you must what? In each IFRS. So first of all, you must know 5 things. So you can call it the 5 key issues. That's all. So before you could understand IFRS into details, you see there are only 5 things. Wow. Every standard contains 5 critical issues you must know. 2 of them are always examinable. The rest, once a while, we normally keep it in exams, depending on the examination type. So please and please again, note these 5 key issues. 5. Now let's go straight to the game. Every standard, you must know the objective and the scope of that standard. So number 1 is what? The objective and the scope of the standard. Good. That's the very, very first section. Objective. Why that standard exists? Anyone to tell us why that standard? So basically, why that standard? What's the rationale behind that standard? So that's the objective. And I can help you out for you to draft the objective for all the standards. This is an easy job because the objective of every standard is that standard itself. So if you know the name of that standard, you should know the objective. So I'll give you a template. If you know the name, just know the name of the standard, then you should be able to tell us the objective. With the exception of few ones that this formula cannot work on them. So now let's go straight to the box. Now, the objective of every standard is to prescribe the correct accounting treatment of that standard. So let me, good. Let me list them first, then I'll pick them up one after the other. Objective and scope. Then we go to definition of some terms. division of terms. Then the recognition. Then number 5, we have measurement. Should be 4. We have measurement. Number 5 is a disclosure. That's all. So every standard, you must know these 5 items. Every standard knows 5 solid key items with every standard. So if I don't introduce to this and if I just start the standards, you may ask yourself, what is this guy saying? Why do you start from this? Why do you start from here? That is it. So every standard, before you learn every standard, there are 5 key issues you must look out for. And that is what you must know. So most often, people don't really understand the standards. It's not because the standard that is difficult. The order that they're supposed to know it is missing. And I don't think they get it so wrong. Now, let me start with the objective of every standard. So the objective of every standard is to prescribe the accounting treatment of their standard. So here you can see that to prescribe the accounting treatment of, then you mention the name of the standard. So as long as it's not the name of the standard, they say giving it recognition, comma, measurement, and disclosure requirements. That's it. So objective of every standard, if you know the name of the standard. So let me give you one of the standard known as the one you're going to do today, maybe IAS2. It talks about inventories, accounting for inventories. So if I ask you that what's the objective of IAS2, you tell the examiner. The objective of IAS2 is to prescribe the correct accounting treatment of inventories, given their recognition or its recognition, measurement, and disclosure requirement. That's all. So I hope you get it very well. Good. So the objective of every standard is to prescribe the accounting treatment of that standard. So if I give you a standard known as IAS 16 PPE and ask you for the objective of PPE, you should be able to tell me that, oh, the objective of PPE is to prescribe the correct accounting treatment of what? Of PPE, giving it recognition, measurement, and disclosure requirement. That's all. So this, should any examiner ask you? No. And please, both student and examiner, if you quote any standard, you have to write its name. So you can't quote a standard without giving us the name. So imagine they ask you to discuss the objective of IAS 16 PPE. They will quote it and write the name. And now you also have your template. Just cut or copy the name and put it there. You are free to go. So as a result of this, most examiners don't ask this question. I doubt any professional body will ask you what is your objective of this particular standard. No, but you have to know it for your own words. personal use or for explanation purposes. Now let's go. Now the next one is the scope. The scope. So you see there are 5 items you must know under each standard. For those who just join us, 5 standards you must look up for. 5 issues under each of the standards, which has been explained as this. Now, we are the scope. It's very important. The scope, yes, it's one of the dangerous aspects. The scope. Many students don't take it serious, but it has a significant impact because every standard has a limit where it starts and where it ends. So every standard has what? Where it starts from, the items that it can what? It can treat, items that it will help us to what? Record. We don't have a single standard that can capture everything in it, no. So every standard has what? Exception, has a scope. So you must know the scope. The scope simply means coverage. Does it cover all items or we have exceptions? So tell the examiner that the scope is about the coverage. Does it cover all items? You see, even the light water bodies that we have on this earth, they are what? Demarcations. They are demarcations. And we move on with the game. You see, large water bodies as what? Demarcations. Let me give a typical example. If you take the ocean, they are demarcation: Pacific Ocean, Atlantic Ocean, Indian Ocean, and then the rest. So the same way, when it comes to IFRS to their demarcations, if you know these demarcations, it make the standard very, 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 very interesting. So every standard, please, this side is very important. No examiner may ask you directly, but you need it to solve all IFRS questions. There's no standard that does not have a limit. There's a limit to all the standards. So know that. So even if you take, like I was saying, if you take the large water bodies, they are demarcations, right? Yes. You see, if you take large water bodies, ocean, different from sea, different from Gulf, but all these are large water bodies. Even within the ocean, there are distinctions. Thin line between Pacific Ocean and Atlantic Ocean, which has tend to be what? A tourist site. No problem. So you can try this for your evening relaxation, the difference between ocean, sea, and Gulf. If you get the answer right, can you send it to me? I'm interested. Ocean, sea, and Gulf. Ocean is the largest water body we have on this earth. And anytime ocean touches a dry land, they call it a sea. And Gulf is an ocean that divides countries, that join countries together. So probably Gulf of Guinea. For those who have been in geography class, will testify this. Now, when it says scope, here tell the examiner that it covers all. They mention the name of the standard, except those covered in other standards. So tell the examiner it covers all. They mention the name of the standard. So you say except those covered in other standards. So that is a scope. And here, every standard have its own limitation. So please, every standard has its own words, limitation. So every standard I pick with you, I will clearly tell you where it starts from and where it ends. So that in exams, the examiner can mix the story for you. He will actually mix the story. You must know where IAS2 starts from and where IAS2 ends. The rest of the story is not captured in IAS2. You see, if you like check all questions, we normally tell you in accordance with the relevant accounting standard. In accordance with the relevant accounting standard, prescribe the correct treatment. With accordance with IAS2, inventories, tell us the treatment. So here you must know, and please again, at the final level, anybody that is aiming to write or the professional institution, the final level, that is what we normally use to reduce the pass rate. Give them a lot of stories, mix them together. Add all the exceptions together with the inclusions. And they will mix all together and treat it for you. So please, this side is very important. So here, it's on standard by standard. Let me give a typical example. Let's go to IAS2. It talks about inventories. Ordinary inventories are stocks that you do in. Inventories are what? They are stocks. They are goods that you do in. No problem with that. Now imagine one of the goods, you are a cocoa farmer. The goods that you definitely would do in what? Cocoa beans. Those cocoa beans that you have available, even though they are inventory, it's a typical examples of inventory. You can never use IAS2 to record or to treat or to account or to measure or to value or to recognize cocoa beans. Why? If you are a farmer. Because cocoa beans is an agricultural produce which have a bigger standard called IAS 41, agriculture. So once there is a standard that exists to treat an aspect of inventory, IAS2 cannot govern that aspect, treated in another standard. So take notice. So once we have cocoa beans as an example of inventory, and there's a full standard that talks about cocoa beans, IAS2 can never treat it. That is the limit that we are talking about. If you understand this, application of the IFRSs will be very easy for us. And that is why we are in here, to make sure that the application of the IFRSs becomes something practical, something easy, something that once we call ourselves an accountant, professional accountant, you must have this as part and part of us. How do you get it? Good. So basically, that is it. Now let's move on. So I'm done with the scope. So here, every standard that I will start with you, I'll always tell you the scope, where it starts from and where it ends. So take notice of those ones. So that in exams, when examiner bring in foreign issues, you tell the examiner that, wow, this one there, I've gotten it. This item, so and so, does not fall under the scope of what? IAS2. That's all. Then you leave it. Then you treat those that fall under the scope of IAS2. This is very important too. Good. And then that is that. Okay, so basically, you get it right. Now let's go to the next section. The next section will be after the scope. Where do we go to? After explain. Then definition of some terms. Yes, every standard defines terms. Please, there's few items that you must know. You see, every standard defines 8 terms correct. So you must know the actual definition, how the standard defines. For example, intangible asset. Please know the definition given to us by IAS 38. Not the layman's definition, not the general meaning. Please, and please again. There's a difference between definition, explanation, discussion, and outline. These action verbs that they use in exams plays important role. When they ask you to explain that one your own words, just tell anything you know about the thing. It's an explanation. But when we ask you to define inventory, define this, that's when we want the standardized version. Or make sure that you have the standardized version in your definition. So the word definition means tell us the standard form of it. Yes, you can define it in your own words. Make sure that the key terms are in your sentences. We are free to go. If the key terms are in your sentences, you have defined it. So take notice of this. Every standard defines terms. So those ones, I'll leave them for you. I'll prepare material for you. So in those materials, you can get them in. If you have any of our material, we have a digital platform where all our materials are centralized. So you have access to get those materials on board. Now let's go. So now we are done with the definition. So when I pick each standard, I will at least define one or few terms in it for you. I don't normally define many because that you can easily go through it, and then I only define the technical ones, those that are of a little skirmish, like intangible assets, investment properties. Those ones I normally define them with you. Recognition. Now the recognition talks about how to record the item. So recognition is the act of including, recording, treating, accounting for that item. So that's the meaning of recognition. So recognition, you ask yourself. So anytime they ask for recognition, they're asking for the accounting treatment. Will it be recorded as revenue? Will it be recorded as revenue? So you take notice. Or expense, or equity, or assets, or liabilities. That is the real. Now, and you must know the criteria, each item. You see, in accounting, you can't just wake up and say, I'm recording transaction in the books. Like, we don't do that in accounting. In accounting, before you record any transaction in the books, you must have evidence. You must have a criteria. You must meet certain conditions. If you want to understand accounting very well, know these conditions. Know the condition and know the scope. The rest is mathematics. Conditions and scope, the rest are mathematics. Addition and subtraction. Conditions and scope is very important. So before you can record assets in your books, there must be conditions, revenue conditions. So every standard that we'll pick, know its conditions before we record that item, and how we record that item is very important. I hope you get it very well. Good. So conditions for recording transactions in accounting is the most important thing ever. Because after you get the conditions right, before you now think of what? The value to place on the item. Condition comes before the valuation. Recognition comes before valuation. So after you've agreed that yes, this is an asset, all the conditions suggest that asset exists, no problem. Then what should be the value? You now think about the value. If there's no asset, forget about the value. So the condition. So every standard that we are going to treat, we'll take our time to learn those conditions very well. And that is all. And how we can apply these conditions, we are done. So that's about the condition. Then we go to the measurement basis of the assets. So 5 key things you must know. Measurement. The word measurement means value or the valuation. The measurement basis. You see, measurement what? Basis. So every asset, every transaction, what should be the value? It's very important in accounting. So the valuation, we are going to look at for how we could value these transactions. App is very clear. Good. So the valuation is very important. Valuation. Now let's move on. Here, every standard have its own specific valuation. Some of them are depreciated cost, fair value, and the rest. Now let's go to disclosure requirements. Disclosure requirement, you see, what is disclosure? To enable consistency or to enable comparability, there must be enough or adequate and timely disclosure. That's what I always say. To enable comparability, there must be what? Adequate and timely disclosure. Disclosure simple means, you see, accountant to prepare a financial statement. Let me see if I have a copy here. Accountant to prepare a financial statement. Let's just assume that this is a prepared financial statement. Accountant to prepare a financial statement like this, and they will drop a copy to you. So your comprehensive income, first page. Changes in equity, second page. Financial position, next page. Cash flow statement, next page. And if the accountant did not disclose how the transactions were treated, the judgment, some of the standard, their options, the entity have right to choose between some models. So the disclosure, you are going to tell us all the judgment, all the assumptions, all the basis, all the thought that came to mind that you have used to prepare the account, tell us so that we can follow. Without adequate disclosure, users will not be able to follow your account. I don't know whether your depreciation was straight line or reducing balance. Tell me. You never told me, in fact, you never informed me the basis of the report. It will make the interpretation very difficult. Trust me. It will make the understanding difficult, interpretation very difficult, comparison very difficult. So disclosure is very important. Unfortunately, many examiners don't ask this question in exams because they feel like it's a theory and it's like a textbook question. What do I mean by a textbook question? The answer is very straightforward. You know that, like, you list the answers and you go. Most examiners, professional examiners, don't like questions like that. To ask a textbook questions, no. So they don't normally ask. Only few examiners ask it. But please, for the purpose of your professional career, try as much as possible to know at least 5 disclosure issues of each of the standard that we are going to learn here. So that we have people who are picking our videos for practical sense, they can also apply this because they are disclosure requirement to every standard. I'm done. So I can now comfortably start the standards. every standard 5 items you must know. Failure to understand these 5 will be difficult. All right. Now let's go straight to the first standard on the list. Today we are going to look out for IAS 2. It talks about accounting for inventories. It was issued on October 1975. You see, in October in 75, they issued a lot of standards. You see, that's where they issued the first standard. The first standard came in, IS1 came in 75. Around October, they brought the IS2. And then the rest of the standard follows in that order. IS2 will basically prescribe the accounting treatment of what? Inventories. So now we know the scope, we know the objective. So the objective, you must know it. I'll not talk about it, because I've explained it already. That the objective is to prescribe the accounting treatment of. So if I put inventory here, that's all. I'm done with the objective. If I come and put inventories here, or inventories, I'm done with what? With the scope 2. What a wow. But here I'll go very specific. And this standard has gone through a lot of what? Updates. Even somewhere 1993, it was revised. Because please, the first name they give it to IST wasn't even true. In 75, when this standard was issued, man, you see, they call it the evaluation and presentation of inventories in the context of what? Historical cost system. That was the name they give it to it. It's not that we have changed things. So some of the things that you are learning, the update that has gone through, I have no idea. But don't worry about all those updates. It's not important. What matters is I know the current version is enough. The old stuff are no longer relevant to us. So now let's go. So first, let's go to the scope. The scope of IS2, it covers all inventories except those covered in other words, standards. So you have to tell us those that we account for in other standards. So give me examples of the inventories that are accounted elsewhere. So that's the exceptions. So let's go. And this side is where you have to take it very serious. Why? Scope. So third examiner. IS2 applies to. It applies to. Let's go. It applies to all inventories except 1, financial instrument, please. So financial instruments on an inventory. Financial instruments. And when I mention financial instruments, I'm talking about IFRS what? 9. You see? IFRS 9. So imagine they put a question. In the question, among the entities inventory, there's a financial instrument there. And now the examiner asks you, with reference to IAS to inventory, what should be the amount? And you've added a financial instrument to inventory. Even if it sounds like it's an inventory, please. The standard says it has a bigger standard that talks about it. So we don't treat it there. Good. Then another one is called biological assets. What is biological assets? Biological assets. Or that is agricultural produce. That's biological assets. So, except number two, biological assets. Biological assets. What are biological assets? Relating to agriculture activity. Relating to agriculture activity. IAS 41. So, for example, the example I gave you, a cocoa farmer who has a lot of cocoa beans. One may thought that the cocoa beans is an inventory. Yes, you are not wrong. Cocoa beans is typically an inventory. It's a stock, trading stock for the cocoa farmer. But there's a bigger standard that talks about cocoa beans. So the mere fact cocoa beans is an inventory, you cannot use IAS2 to govern it. So in exams, when examiner put a lot of issues in the case, cocoa beans is part, they are cocoa farmers. Please, provided that they are cocoa farmers, so please, in agriculture activity. So if, let's say, chocolate manufacturer, chocolate what? Manufacturer, going to buy cocoa beans from a cocoa farmer, then transfer the cocoa beans into cocoa paste. Then you proceed to do what? The chocolate. Now the question is, can he account which of the standard he must use to account for the cocoa beans he has purchased from a cocoa farmer? Have you seen the question? Chocolate manufacturer who processes his own cocoa beans buys the cocoa beans from where? From a cocoa farmer. Store these cocoa beans, process the cocoa beans into cocoa paste, and further manufacture the chocolate. The question is, which of the standard? If you are the accountant of such organization and you are preparing the financial statements, are you going to prepare the financials? Are you going to account for the cocoa beans under IAS2 or IAS41? Which is which? IAS2 or IAS41? IAS2 or IAS41? Obviously, that would be IAS41 because chocolate, production of chocolate, you are a manufacturer. You are not, it's not part of what? Agriculture activity. You see, at least transforming the beans into the paste, we can say that yes, it's a part because that becomes agro-processing. Agro-processing is agriculture activity. Yes, agro-processing. By a manufacturer who manufactures chocolate, accounting for cocoa beans and the IAS what? IAS2, because an inventory trading stock. But a farmer will account for it under what? Under IAS what? IAS 41, agricultural produce. I'm done. So these are the scope. And we are done. So I'm done with the scope. Let's go to the recognition of, no, definition of some terms. There are a lot of terms defined. I'll only define inventory. That's what I'll do. So the terms, don't forget every standard, we normally have to go by these 5 ways, these 5 key items. So let's go. Inventory, what's the definition for inventory? How does the standard define inventory? So that is what we have to look out for. So inventories are assets. You see, the standard defined inventories are what? Are assets that are made up of, so inventories, let me do this way. Assets made up of what? Let's go. 1, raw material. Finish, in fact, work in progress. Finished goods that I had for sale in another course of business. So finished goods. That is called held for sale. Third examiner. They are held for sale in the ordinary course of business. Ordinary course of business. Number 4, supplies or consumables. So production supplies is also part. Production supplies. I normally call it components. Yes, I call it components. Or other consumables. You can also call it other what? Consumables. That is it. So for instance, Toyota manufactures car, but they have other components like the car tape. So and other parts. Maybe they will buy the type from the Hankook. So customized type from the Hankook. Not, you can't get a company that can produce a full set of every part coming from them. Hardly, only few companies can do that. If like take a computer, HP will manufacture the motherboard and case and go and buy the processor from Intel. And after they finish everything, you also go and buy it from the shop. After you buy the laptop or the computer from the shop, what do you do again? You also go and buy Microsoft for Windows. After you get the Windows on it, before now the laptop will work. So why is that HP did not manufacture their own motherboard, their own case, and their own what? Processor? And again, when they finish, their own what? Operating system? No. So that is what we are talking about. So inventory comprises of all the other components that you normally use and other consumables. Other consumables. That is the definition for inventory. My question for the day is this. So question. Imagine we are bank, financial institution, or a company that does not sell rice. And at the end of each year, we conduct what we call end of year party and reward all our employees. So normally give them some kilos of rice, each employee, and other items. Last year, we did. This year, the same thing will happen. But last year's own, please have to get the question clear. We are normal company. It can be a bank, financial institution, any company at all. The only caveat is that we don't sell or we don't buy and sell rice. Rice is not part of our ordinary course of activity. But we normally give out rice as part of our bonuses to encourage employees for their commitment. Last year, we bought about 5,000 bags of rice, costing 50,000 cedis. 50,000 Ghana cedis. Now, we could not share all the rice. We shared half, exactly half. That is 2,500 bucks, costing 25,000. Now 11 half. Where do we treat this half? I need an answer to this. Comment your answer. So practically, we don't deal with the rice, but we still have rice left over available. What should be the accounting treatment? If you are the accountant, will it be part of your inventory, even though it does not form part of your direct trading? Let me hear your thoughts on this. These are for practical illustrations. All right. If you got the answer, let me know. I'll respond to it right away. If it should be part of inventory or it must be written off. I'm done. Now let me move on to the next section. Now we are going to the recognition of inventory. So what is the accounting treatment of inventory? This side is a bit dicey. So third examiner recognition of inventory. Inventory, there are two types of inventory. There are two types of inventory. We have what you call open inventory. Open inventory. So open inventory and what? Closing inventory. Open inventory is also known as what? Sold goods. Then we have closing inventory or unsold goods. That is it. Sold goods and what? Unsold goods. So sold goods and unsold goods. How then do you treat them in our books? With open inventory, please tell the examiner that open inventories are treated as an expense. So tell the examiner cost of sold goods. The cost of sold goods are expensed. That's all. To be specific, we add to cost of sales. It is from what we call matching concept. This one is coming from where? Matching concept. Get it clear. Now, what is matching concept? What does the matching concept say? Matching concept is saying that if you want to determine the year's profit, match all the year's revenue against its related expenses. Good. So if you want to determine the year's profit, you match that year's revenue against that year's profit. Because that goods was sold, its revenue has been added. So equally, its cost must also be added. So take note. It's like this pen. The year that I will sell it, that should be the same year I must record its cost as an expense in a book. That's the meaning of matching. That's the other side of matching concept. You match each revenue against its cost, its related cost. That is where you can determine the profit. So if I have this pen and I have not disposed it, if I have not sold it, if sales have not taken place today, I cannot match its cost in today's records. I have to wait when the sales takes place. Because the comprehensive income, the profit is consumption, what we have consumed. Good. So basically, that is it. So please take notice of that. And then we move peacefully. Now let's go to closing inventory. The unsold goods. So the unsold goods have not made any sales from it. So I can never match its cost because I have to wait. So that is why the unsold goods are treated as what? As an asset. It's a property to us. Any leftover goods are property because I have not disposed it of. So I can't match its cost. So if I put the cost in account, there's no related revenue to offset it so that the profit will come. Hence, unsold goods, aka closing inventory, is not an expense, it's an asset. So the cost of unsold goods is treated as an asset. To be specific, current asset, but not an expense. Good. So take note, that is where matching concept tell us. So at the end of the day, that is why if you are calculating cost of sales, now, cost of sales, you see, you start with open inventory. You are adding because open inventory is an expense. You are adding it. We add. Why are we adding? Because an expense. Then we say add. Again, add your purchases to it. I mean the net purchases. Then less what? Closing. Let me explain things to you here. Closing inventory. We are lessening this closing inventory because its related expenditure is here, but its related revenue is not there. But this closing inventory is part of these purchases. Among the goods we bought, we still have some of them available, unsold what? Goods. So that is why we call it closing inventory. Then we can now say cost of goods sold. So listen to the word though. Cost of goods sold. So the actual goods that we have disposed of, this is their cost that we can match. So take notice of this. This is very, very, very crucial. And here we are setting the standard right. I am treating the first 10 standards. There are only 45 standards you must know. And I will treat all the 45 standards in accounting. Don't worry. 28 IASs and 17 IFRSs currently in a good shape. But I'm treating the most 10 important standards first. Then I'll do the next 10, the next 10, the next 10, the last 5. The last 5 will be those standards some Sometimes not even hear about it before. We'll treat those standards. They are last. They are not important now. So now I'm done with the recognition of inventory. So inventory, anytime any examiner asks you, how do we treat inventory? Ask the examiner, what type of inventory? Because if it's an open inventory, it's an expense. If it's a closing inventory, it's an asset. So examiner, can you come again to tell me which specific type of inventory you are talking about? I can also tell you the treatment. I'm done. Now let's go to the measurement of inventory. So right after measurement, disclosure, we are done with IS2. Then I'll pick the next standard. Now left question solving. On Fridays are question solving day. Fridays are questions. So check the timetable very well. This is a fully packed program. And this is an executive master class free of charge by Target Professional Consult. Please, if you have not subscribed to our YouTube channel, please do so before you continue. Yes. And make a recommendation to a friend. Now let's go to the measurements of inventory, the valuation of inventory. That is where the difficulty will probably be. Measurement of inventory. So let's go measurements. Measurement of what? Inventory. What a wow. Measurement of inventory. How do we measure inventory? When you say measurement, as I stated earlier, how do we obtain the value? You see, financial reporting, corporate reporting, financial accounting is about report. You're reporting on figures and numbers. Have you ever seen an account that you have reported there's no figure inside? Ask yourself that question. That you say you are preparing an account to account. You finish your account, there's no figure inside. It has turned to what? HR accounting. It has turned to something else. No. So then how do you obtain these numbers and figures? That's the measurement basis. How to obtain numbers and figures. So all the calculations you see in accounting are under what? Measurement basis. So IS2 inventory. And there are two types of the measurements. We have the initial measurement. Initial measurements. And then we have the subsequent measurement. So measurement of inventory, we have the initial measurements, number two, and what? Subsequent measurement. Now, when you talk about the initial measurement, let me draw a diagram here for you to see how it works. The very first day you bought the goods, what should be the value? So imagine our year starts somewhere January. Around March, you bought goods. So bought goods. That is initial measurements. So tell the examiner initial measurements. You can say initial value. Then the next reporting period. Next reporting date. What should be the value? That's a subsequent measurement. And the next reporting period as well. So these are the things we say subsequent measurement. So please understand this term for us so that when we use it in exams, you are okay. When you say initial measurements, the very first day you get the goods, what should be the value? So imagine you are a trader You buy second-hand phones and resell them. Circle is your wholesale joint, no problem. So anytime you go to Circle to go and then get these goods at their large quantity and come and sit at your shop, repair some of them, change certain parts and sell them. The very first day you got the goods, what should be the value? It is called what? Initial measurement. Another name is called initial recognition. Please tell the examiner, initial what? Recognition. Initial measurement or initial recognition. Don't forget that this is the what? Wholesale or headquarters of what? The IFRSs. Good. Then after the initial measurement, your next reporting period, what should be the value? That becomes what? Subsequent measurements. Now to call it measurement after the initial recognition. Wow. Measurement after what? Initial recognition. Take notice of this term so that when examiners are setting questions and they use them in their questions, you understand so that you can apply it well. Sometimes we say we are accountants, but the terms they use in the questions even confuse us much more than somebody who have not studied accounting before. Yes. The terms they use in setting the question sometimes confuse us much more than anything. So that is that. Seems that I may finish IES2 very soon.
Oh.
So let's start with the initial measurements. All initial measurement is at cost. So inventories are initially measured at what? At cost. Good. So in inventory initially, when you say cost of inventory of inventories refers to three things. Number one, cash. Number two, cash equivalent. Number three, fair value refers to, let me put them together, refers to cash, comma, cash equivalent, and fair value of other consideration transferred to acquire the inventory. So what are the key terms? Cash equivalents, and fair value of other consideration. So when you say cost of an inventory, imagine we buy and sell rice. So how do you obtain the cost of? So when you say cost, simplest language, it means how much we paid for or the total amount that we have to sacrifice. Anything plus anything that we have to sacrifice. It includes number one, cash, physical money. You paid with physical cash. Number two, cash equivalent. When you say cash equivalent, they are certain instruments, certain things. In fact, they are not cash, but they resemble cash. They can behave like cash, and therefore they can be equal to what? Cash, and hence they are equivalent to cash. There are certain things, they are not cash, but they can behave like cash. So they can be equated as what? Cash, and therefore they are equivalent to cash. Number one is check. If you give someone a check, it's not cash. Please, check is not a cash. But check, to some extent, it can play all the roles that cash can play to some extent. So we can answer that check or a bank account is what? Is a cash equivalent. It's equivalent to cash because it can play the same role. You see, this is an African proverb. If you, in fact, if you send a chicken to go and buy a meat for you and the goat doesn't get some, you can convert him to be a meat. There's no value difference between a chicken and meat, right? All of them are what? All of them give what? Protein. Simple as that. So when you say cash equivalent, anything that we can use to pay someone, it can also be in a form of negotiable instrument, like form of certificate of deposit. At least have a certificate of deposit can also be used. Then the fair value of any other consideration, swapping. Sometimes you can use your old abandoned car to go and exchange for what? The goods you are buying. You bought some goods. You don't have physical money to pay. But the supplier agreed that you have to exchange your vehicle for the goods. In that case, what should be the value? So you get it? So the cost of should be like that. And then that is all. So let me give you a typical example. For example, please take note that there's question solving section. So though we are not doing the two all together, one at a time. For example, targets professional consult. Acquires what? Acquires goods from goods makers limited. From goods makers. Goods makers limited. On the following terms. What are the terms? Let's go. These are terms. The costs of the goods. The cost of the goods is what? It's, let's say, $20,000. That's the cost of the new goods that we are buying, $20,000. Comma. but the supplier accepted cash of $10,000 and a check and a bank deposit of $2,000. And what again? So this one should go off, comma. And old office vehicle of target professional consult. Purchased 5 years ago at $30,000. I just want to make the question great. With the current amount of $18,000 and a fair value of $12,000 required. Determine the initial value of the goods. Full stop. Start work. So here, only 3 things you need to know. 3 things, solution. 3 things. If there's a cash component, just look for 3 things and add them. The cash components, the cash equivalent components, finally, the fair value of the other consideration, you add them. That's all. So here, what will be the answer? So let's read slowly. The total cost is $20,000. Should it be 20,000? No, please. You see? We have to take things careful. Cost is not how much we are selling it. It's how much I paid for it. How much I sacrificed for. Not how much you have quoted it. Sometimes you may quote 10,000. But by the time we finish the transaction, I will spend much more than 10,000. That's not the cost. The cost should be the total sacrifice that I have to do. So take notice of that. So the cost will be cash. The cash is 10,000. So I'm going to put the 10,000 there. Cash component is $10,000. Then bank deposit, cash equivalent of 2,000. Then office vehicle, he bought some years ago, 30,000. No, I'll not use the 30,000. I have to use the fair value. You see, they gave us a lot of figures to just confuse us. The fair value of the vehicle is 12,000. So you have to use the 12,000. Putting this together, you get what? So the vehicle cost now is 24,000. Not the 20,000 stated in the question. So to the entity, if you have your physical cash of 20,000, just come and buy the vehicle and go. Come and buy the goods. But because you are adding a lot of stuff, now the cost has gone up. That is in your books. So that's all. Now, let me finalize it with we have the composition, or we have the inclusion, of costs of inventory. You also have the exclusion. Good. I'm doing all the two at the same time. Exclusion from where? From costs of inventory. In brackets and operating expenses. One, it includes the purchase cost. Please, when you say purchase cost, what does it mean? When you say purchase cost, the word purchase cost means one, purchase price. So imagine we buy and then sell rice in a smaller denomination, usually olonga, margarine, in a smaller quantity. We normally buy the big sack, break the sack, and retail it on a small what? No, somebody needs just a cup of rice to do something small. The person probably won't have the capacity to go and then what, acquire a full sack. So we have taken that. That's what we mean by value chain. Now, how do we determine the cost? When you say purchase cost, that's the actual cost, what we paid for. We call it the manufacturer's base price, X factory price. It includes one, transportation or delivery. Delivery of the goods from the point of purchases to the warehouse should be part. We call it carriage inwards. So carriage inwards should be part of it. Import duties. Import duties and what? Irrecoverable purchase taxes. Sometimes you pay VAT, the VAT that you pay. If you can recover all the VAT, all the taxes you paid on it, please don't add it to it. Where you cannot recover, so you call it irrecoverable purchase taxes, you have to add. Which one again? Less trade discount or similar. What is trade discount? Let's just assume that you bought a lot, so they reduce the price for you. Take all those ones out. And the rebate, maybe tax incentive you receive on your goods. Because you sell educational materials or health materials, there's always a rebate. Simple means a reduction in price by the tax authorities or wherever. You list all those ones and then you are done with the game. So I'm done. Then you go to the next one, you call it conversion cost. Conversion cost. Conversion cost. Cost of converting the raw materials into what? Into finished product. It's made up of direct labor and overheads. I call it production cost. Both variable and fixed. Take notes. Both variable and fixed. So direct labor, direct expense. Let's just assume that when we bring these 5,000 bags of rice to our warehouse. We have to employ people to do rebagging so that they can now transfer it from where? A bigger sack into smaller quantities. We will pay. So that's a direct labor cost. Overheads, you have to pay for warehouse cost and other direct charges. All these become part of what? The inventory. We are done. At the end of the day, the last one is called any other cost. That one, other costs that are necessary to put the inventory to their present condition or location. So other costs, any other costs which are necessary to put the goods to their present condition. Now the following must be excluded from the cost of inventory. You must exclude the following from the cost of what? Inventory. Number one, general and what? Admin expenses must be excluded. All these are operating expenses, so take note, don't bring it in. Please, exclusion doesn't mean go and subtract, please. Exclusion simply means don't even attempt it at all. Do as if it's not even part of the story you are telling us. That's all. So if by mistake they have added, you take it off. By mistake they have subtracted, you add back. We are not supposed to even touch it at all. The right place of this item should be in a comprehensive income, not capitalizing it as an asset. Number two is what? Initial operating losses. Initial operating losses. Or let me put it right way. Wastages or abnormal losses. Wastages or what? Abnormal losses. Let's just assume that in the course of rebagging the rice from the larger quantities to smaller quantities, a full bag of rice accidentally pour on the ground. Unfortunately, we lost everything to the sand, to the gravels. So don't tell us that this loss should be part of the cost of my rice. No. That loss should go to the P&L as operating losses, not capitalizing loss on your balance sheet. Not capitalizing it, please. Number three, selling and distribution costs. Selling and distribution cost. Number four, settlement discounts. This one should not be part. Settlement discounts. So we are done with the initial measurements. Now let me go to the subsequent measurements. And basically that's all for IAS2 inventory. So let's all move on to subsequent measurements. I'll finish it before we end the section. Subsequent measurement of inventory, that's at the end of each reporting period. Is that examiner that at the end of each reporting period, inventory must be stated or valued at the lower of costs and what? Net realizable value. That's all. So you compare two things. Select the lower. NRV and cost. That's all. NRV and cost. Now the cost, let me talk about the cost. And I'll talk about the NRV here. Then we are getting to the tail end. So when you say the cost, what are you talking about? Cost of inventory. Subsequently, we normally have the cost formulas. So we normally use what you call cost formulas. Number one is the actual cost. Actual cost to date. Number two, the retail price method. Number three, the FIFO method. Number four, the average cost method. Please, LIFO is bound. LIFO is not allowed. Take notice. IS2 does not permit valuing the cost of inventory using what? LIFO. It's not part of the story. But the US GAAP allows. So in US, they value closing inventory using LIFO. They can use LIFO because it is allowed in US. But all the IFRS countries, it is not allowed. Take notice of that. All right. Now let's go to NRV. Let me also talk about NRV here. What is NRV? In my honest opinion, the word NRV simply means if we should sell the goods today, how much can we realize from it after all selling costs? That's all about NRV. After all what? Selling costs. So that's the meaning of what? NRV. First, so it is estimated selling price so much estimated cost to complete the sale. Say less estimated cost to sell. So this is the NRV. Now, estimated, this one, NRV simple means is the amount that we can realize from assets through sale after all selling costs. That's all. Any amount we can realize. Now, at the end of the day, we compare the two. Select the lower. When we say cost, let me explain the key words. Estimated selling price over here refers to is, you see, NRV is always, it's an estimate figure. This is an estimated figure. The cost is always actual. This one is always actual. Wow. One is a guesswork, one is actual. One is recorded, one is not recorded. Always the cost has been recorded. Actual cost of the goods has been recorded. But NRV is an estimate. So it's not in the books. Now, estimated selling price. How much we should sell the goods today? Estimated cost to complete the sale. Estimated cost to complete the sale. You put it down. Estimated cost to complete. When you say cost to complete, imagine we are selling this device. Imagine we are selling this device. You are selling your laptop. Imagine you are selling the office vehicle or the goods. But the customer have requested that we must repackage it. So the repackaging cost. It does not mean that the goods is not complete. No, take notice of that. The goods is complete. Just that to complete this sale, customers' requirements. Yes, repackaging, modification cost. Maybe the branding of that item, the goods. If you are going to market A, central market, I must brand it yellow. But if I'm going to the other market, I have to brand it what? Like pink. All these costs are called cost to complete. Then selling costs. Selling costs are agent fee, commission, discount. That's all. We are done. We just left with 2 subtopics, then we are done with the game. Now, anytime NRV is lower, this is what you have to do. So accounting treatment when NRV is lower. Please, when the cost is lower, you do nothing. When the cost is lower, do nothing. But when the NRV is lower, it requires for what? An accounting treatment. Take notice of that. So when the cost is lower, you continue. When NRV is lower, it means that the inventory must be written off to the NRV. Hence, or the inventory must be reduced off to what? NRV. This means that there must be inventory write-off. Inventory write-off. That's the difference between the costs and then the NRV. You write it off as an expense. As an expense. Yeah, so at the end of the day, anytime you reduce your inventory from cost to NRV, you have to write off the difference and expense in your book. Now, last section, then we go to the disclosure, then we are done for this section. Now, you see, why do you think why NRV may be lower than why NRV may be lower than the cost? So you see, why NRV may be lower than cost? You have goods, but the cost of it, at what time, whatever you can realize from these goods will be lower than the cost of it. That means you are entering into losses. Yes. So you bought a goose for 50,000. But as I'm not talking to you, you are not sure if you can realize this 50,000. You can realize something lower. What should be the cost? Why? At what time? What are the circumstances that cause for that? Number one, when there's a decrease in selling price. Decrease in what? Selling price. Number two, you see when the selling price decreases, you cannot recover. When the inventory is a slow moving inventory or damaged goods, like broken tiles, like goods that they are getting closer to their expiring date. They say reduce to clear, please. Some of the reduce to clear, the goods are getting closer to their expiring date. So take notice. So if you see someone who have reduced its goods about 75% slash off, it tells you clearly that NRV will be lower than what? The cost of the goods. Hence, it tells us something else. Number three, it can be strategic management decision. Strategic management decision. You see, Coke, yes, and Pepsi. Some time ago, around 2017, 2018, Pepsi said that still 1 cedi. Coke was around 3 cedis, was around 2 cedis. And Coke reduced it, the price from 2 cedis to what? 1 cedi. To come and what? Compute successfully with that of Pepsi. That is it. Management strategy. So sometimes management want to win. And that's why they did that. All right, so we are done. Now let me go to the disclosure to end IAS2. That's all about IAS2. What level question solving? And I'll do that. So disclosure, what you must disclose. Now disclosure, one, you must disclose any inventory used as what? Loan collateral or security. So imagine you have gone for loan facility and you've used your goods, you have used your inventory as collateral. In that case, what do? You will probably have to declare that. So that's a disclosure requirement. Take notice of that. Now, the next one is the value of inventory stated at NRV and then the amount of write-off. All of these must be disclosed. All these have to be what? Disclosed. Basically, that is all. So these are the disclosure requirements. There are many in number. And if you get our materials, all of them are in there. You can read from that. And then we move with the game. All right, so if you have a question, can you put them on board? Let me answer them, then I move on with the game. So any question before we close the chapter of today's edition? IAS2 is, we are done. Then we look out for question solving coming Friday, so that on Monday, that's tomorrow, IAS 8 session on board. So IAS 8 will come over next. Please stay intact. All the materials are also available. So we have our materials intact here. If you are on a section, you can get our materials and use them. So all this has been dealt with here. Please, to get access to this material, you have to first of all be on our WhatsApp platform, and you must go to some field verification or registration. As soon as you register, you have access to these materials, so that by Friday, when we are solving the question, you can have access to it, print it out, and have access to all the questions we are going to use. So for now, good. Yeah, so the question solving is on Friday. So Friday, we are solving questions on IAS2 and then the IAS 8. So on Friday, get in touch with us and then we'll move on with the game. So this is the first set of the standards, and then we'll move on. If you have any question for me, you can let me know. All right, so basically that is it. I have some few questions, you have to answer them. First question goes by the disclosure requirement. Please, the disclosure requirements, you must disclose the accounting policy used in measuring the cost of the event. That's the cost formula. So you have to disclose the cost formula. Let me see if I can maybe put some few points down together for you. You must disclose the cost formulas or cost formula use, whether FIFO, weighted average, or the actual cost. You must also determine the carrying amount of the inventory or goods held in current amount of the inventory, or the total amount that we have. And then the classification of the inventory, very important classification. You have to disclose the classification of inventory, you know, whether they are raw materials, finished goods, and those ones. And then write-offs, you have to disclose that to us. And then carrying amount of inventory used as security for debt. That's the disclosure. I hope it's very clear now. All right, so that is that. Let me see if I have another question again. This one I've answered it already. Okay, so that's all. If you have any other question again, you can probably let me have them. The recording is ready just 15 minutes after we end. You can get it live on YouTube. live on YouTube under the heading of IFRS, special IFRSs. You can put them there. And we are doing all the 45 IFRSs. What a wow. This one is small journey. Now let's go. Okay, so any question for me? We'll solve 3 questions under each. 3. The rest are for you. And all those questions that I'll give out to you, I can also show you the same YouTube there. You can get their solutions over there. And then that's all. All right. Any other question before I announce my exit? Please, this is Target Professional Consult. I think today it's a little light issues here, but the evening class will be very superb. So you can afford. Exactly 7 p.m.
Hello.
Joining us to do the case study models, and then we are free to go. 7 p.m. on the dot. If you have any question, can you let me have them before I go?